Okay, guys. Well, we'll jump on. Appreciate you guys joining us on a Tuesday. Hope you guys had a great Memorial Day and a long weekend yesterday. If you have been joining us on these calls for some time, we used to be very like chart and graph heavy, and the last few months has been kind of very much focused on what's happening in Iran and overseas. Um, and we're going to get back to kind of sharing more data, and certainly that's impacted by what's happening overseas. But I've got a lot of charts and graphs today to go over, so we're going to jump right into it. If you would like any of these sent to you, as always, just message whoever you work with on our team, and we will get these in your hands. With that, I'm going to share my screen. And it's funny that we heard someone had some background noise that said the Strait of Hormuz, because that's where we're going to start today. Um, and this is all somewhat interrelated. So, over the weekend, end of last week, kind of the ceasefire talk seemed to pick up. As a result of that, the bond market did react a little bit favorably at the end of last week. You can see from the charts here, we saw a little bit of bond market price improvement. So that's a positive sign. I think we probably all are kind of taking that with a grain of salt, if you will, because there's been times, in the past where there's been ceasefire talk and it hasn't held. So kind of cross our fingers, but the 10-year Treasury's down today. That's a positive for mortgage rates. Mortgage bonds are up. So that's all related to potential, ceasefire talk. But um, so here's what I want to talk about today. So um, we talked about this last week and I've talked to a lot of realtors over the past week. There seem to be two sections of clients right now, those that are taking action and those that are not. And when we look at our overall pipeline, and a lot of realtors I talked to said the same thing, most of the people we have under contract are people that we have talked to for the first time more recently, couple days, couple weeks, maybe a month or two, but they find us, they get qualified, they talk to you, they do a buyer or seller, console listing appointment, and they take action. And then there's this whole massive other section of people that we can call them, fence sitters, or they're on the sideline, or whatever the case may be. But they're people that are, qualified to buy or sell a home, but for whatever reason they're not. And I think the main reason they're not is kind of twofold. Maybe some worry of like economics, job stability, things like that. I actually don't think there's a lot of those, because if someone was concerned about like their future personal, family, economic prospects, aka their job, they probably would have never called us or you guys to begin with. There's a lot of people that are okay in their job. Maybe they're not, like in line for a raise or promotion tomorrow, but they're not like worried about getting laid off, and they're waiting because of probably affordability, interest rates. I think a lot of what they're waiting on is the perception that rates are high and they should wait for rates to come down. And so I don't think rates are going to come down. And we're going to talk about that's kind of the main thing today. But the message that I'm sharing today is a message that we need to take to the people that are waiting for lower interest rates that I don't think are coming anytime soon. And both like in the next couple of days and weeks, and also over the next 2, 3, 4, 5 years as well. And when I say lower rates aren't coming, I don't mean like an eighth of a percent or a quarter or a half. I mean like a point and a half, like, in the fours or low fives. I don't think that's happening, and I'll kind of talk about why. So let's talk about short term first of all. So this is kind of funny. We heard this in the background. This is the Strait of Hormuz. This is where all of the, oil is coming out of the Middle East. And you can see how, inbound and outbound traffic kind of fell off a cliff at the end of February, beginning of March when the war started. Um, there was a little bit of outbound traffic. You saw some peaks and valleys. Initial, kind of ceasefire talk, you saw it surge a little bit, but it's, been kind of limited, and really, up until last week, like things were trending in the wrong direction. It's important that that picks up, obviously, and we've been talking about that for weeks. Um, but what most of us have been talking about is we've been talking about the price of oil, but there's something else that comes out of the Strait of Hormuz in addition to oil, and it's fertilizer. Um, and you're going to start seeing that in food prices. Fertilizer is used to grow food. It's even more of a lagging indicator than oil is. You know, maybe oil is a 1 to 3 month lag, but if you remember, like post COVID 2022, 2023, like every time you went to the grocery store or you use like a delivery service, Instacart or something, it was like, holy cow, how is it that expensive, right? And inflation cooled, some of those food costs came down. I would expect that's going to rise. And so rising food cost means inflation is going to rise. And even though the Federal Reserve likes to use what's called core inflation, not headline, core is without food and energy impacted. And the reason the Fed does that is they can't control food and energy costs. And so when the Fed looks at core inflation, that's what they can influence. But I'm not sure about you guys, but like I buy gas and my family eats. So food and energy kind of matter to us, right? They matter to all of us. And so even though the Fed doesn't really pay attention to it, like people do that are buying and selling houses. Um, and you can see, so this chart here, so this is, World Bank fertilizer prices is the blue line. The red line is like agriculture sub-index. It's just kind of a measure of like food cost. And obviously they track directly in line. But the food cost is a lagging indicator. It tends to move a little bit after fertilizer increases or decreases. So it's kind of a cause and effect. So fertilizer cost increase or decreased at some point in the future, weeks or months later, food costs are impacted. And so when we're talking about our interest rates going down, if someone's sitting on the fence today, our rates going like to 5.5%, that's going to, anytime soon. And is that the number that mentally they have in their head? My opinion is no, like no time soon, and not anytime soon, like in the next 60 days. And we've talked about for a while that we think rates are going to kind of stay in the same level, even with the ceasefire, because inflation's a little bit of a lagging indicator. A firm ceasefire, war is over, everything's, back to normal today. It's still going to take a few months for inflation to calm back down. Um, but I think even longer term, there's reasons why I don't think rates are going to make a meaningful move lower. And so all of this today is just for us to share with that kind of sideline, on the fence person that if you're waiting for 5.5%, you might as well just put like 2029 in your calendar and we'll see in 3 years. And I'm not predicting 3 years, but you guys kind of get the point, right? But the Strait of Hormuz, fertilizer cost increase. This is a chart here that shows price increases in various sectors since the war started. And you can see things like coal, right, that doesn't come out of the Middle East, that hasn't gone up much, but like sulfur does, WTI, West Texas crude, jet fuel, all these that are petroleum based have seen big increases. But even things like cotton and rice have gone up just because transportation costs to ship things, around the world have increased. And if these have increased, we're going to continue seeing higher inflation numbers, and we've seen that, start for the past couple weeks. Um, the producer price index, which is a measure of inflation that measures it at the wholesale level. So think how much it costs Walmart to buy goods and services that they resell to us. That's up 6% year over year. That was a big surge earlier this year, highest level since 2023. When inflation spiked and was kind of trending back down. Um, this is definitely more volatile than the consumer price index, which is what consumers pay, because producers like, let's say, Walmart, eat some of those cost increases and don't pass them all on to the consumer. So an end of the war, we'll see this move down quicker. The consumer price index, on the other hand, is a little bit of a lag. Um, and this just shows you kind of what inflation has done over the past couple years. This red line here, this is kind of since Jerome Powell took over, former Fed chair. If inflation was 2%, that was the trend. That's the Fed's goal. And you can just see that for a period of time, inflation was below their target. This is the blue line, the real number. And then in 2021, it kind of increased above 2% and it stayed there ever since. And so just a comparison of what inflation has done compared to what the Fed's target is. And we're not really getting any closer, to what the Fed's target is. So inflation on all levels has gone up. Um, and then here's a chart. This is the 10-year Treasury, that you can just see this has surged since the war started. 10-year Treasury is what most people say mortgage rates are pretty closely tied to. So again, significant increase in the 10-year Treasury from like 3.9 to 4.6. So 0.75% or 75 basis points here. And that's why mortgage rates have gone from like close to 6 to like 6.6 or 7, pretty directly, correlated to the 10-year. So this is all kind of past information, right? What's happened in the past. Um, from a global standpoint, you're seeing interest rates around the world increase as well. So it's not just in the US. This is 30-year bonds in Japan, the US, the UK, and France. And you can see kind of a similar trend of all of these, really except for Japan. They've always had a very, very low interest rate market. But, bond yields trended lower, kind of 2019 through really 99, through kind of the COVID years. And then, have surged since then. So it's not just in the US, it's globally. And if you're an investor and you're going to invest in bonds, and a lot of these bonds are purchased by foreign governments, Japan and China used to buy a lot of US bonds. But if they can buy bonds from other countries that pay similar yields, that's a reason why you have less foreign investment in the US. So it's not an American problem, it's a global problem. Everybody is seeing higher yields and higher inflation. So it's not just, us at home, it's really everywhere. Um, okay, here is why, or one of the reasons why I don't think even if the war was over today, ceasefire, inflation comes back down, it's, where the Fed wants it to be in a few months. One of the main reasons why, and we used to talk about this a lot, probably 6 months or so ago, that you're probably not going to see rates get into a incredibly low level like we saw for many years, like from 2003 to 2021. And that's our government. And that's a nonpartisan issue. Both, parties haven't really been ultra capable of reducing expenses, balancing the budget. But we continue just to blow through crazy amounts of debt. $39 trillion in debt at last check. And as a result of that, this is the government interest expense. And we've talked about this before, but it's been a few months. But this kind of green line here is government interest expense as a percentage of revenue. Okay. And right now, the government is spending 18 or so percent of their revenue on just the interest. And so let's put that as in real world terms. If someone makes $100,000 a year, they're paying $18,000 in interest, just in interest, not in other expenses, not in principal to pay the debt down, just interest expenses. And what's scary is this is congressional budget office projections, but that's projected to be 25 to 30% of government revenue in the next decade or so. And that's really scary. So think about a third of your income going towards interest expense. Um, this is the darker line with current levels of interest rates, and the dashed line here is with rates being higher. And if you were around with us a lot, like last year, first part of this year, we've talked about the government has a big problem on their hands in that we have massive amounts of debt that we're issuing every day and that's maturing, and we're reissuing new debt, and we're issuing new debt on higher and higher and higher interest rates. And so um, government debt is kind of like an adjustable rate mortgage. It resets. It could be a 1, 3, 5, 10, or 30-year reset. But when a 10-year bond matures, the government issues new debt to replace it. They issue new debt because of our deficit. And think about all of the debt that has been issued. We've been running like $1 trillion deficits since, COVID, 21, 22, really through today. And when they were issuing government debt, when treasury rates were in the twos, right? Pretty cheap interest expense. Think of issuing debt at 4.5%, which is where treasury rates are today. So that problem is only going to increase. And so if you think about supply and demand, um, the more debt AE bonds that gets pushed into the market, the more supply that hits the market. The more supply, the less demand, prices have to go down, yields have to go up. It's no different than if, so one of you guys that's in Orlando, realtors, how many houses are on the market in Central Florida? Just anybody want to throw in the chat, just ballpark, like active listings. Anybody want to throw that in there? Um, I'm not sure. I think it's maybe 10. I don't know. Maybe we'll just pretend and say it's 10,000. Okay. Let's say it's 10,000 and imagine another 10,000 houses hitting the market tomorrow, right? That's basically what our government's doing and has been doing for many, many years with the debt is just issuing more and more and more. And so what would happen to home prices in Orlando where I'm at if we went from 10,000 to 20,000 listings, overnight or over the next few months? You would have to see home prices go down because of supply and demand. And so um, you're going to see more and more of that as this government debt problem continues to worsen, more debt being issued, the price of those bonds or debt has to go down, which means yields and rates are going to have to go up. So let me share kind of our conclusion, or I don't want to speak for my conclusion. So this is a chart of mortgage rates. This is an average 30-year fixed rate mortgage dating back to the 70s. And if you look at this chart, I'm going to pop this link in the chat. It's from the Federal Reserve's website. You can Google it and it's easy to find, but this is a good chart. You can download it to a JPEG and make it shareable on social media as well. Good content, I think. Um, but so let's look here. So Casey, when I scroll through this, can you see, or Aaron, can you see the dates change when I scroll over this? Cool. Okay. So let's look at this 10-year period from like 1971 here through like 1970. Well, it's 7. So let's say 8 years, right? Rates were between like, low to mid sevens and like upper nines. So like a 2 to 2.5% range, okay, for that period of time. Um, you had a big surge from 79 through like 86. So like that 7-year period, things got pretty volatile. So your range was like 10% to 17%. So a little bigger range of that period of time. But then let's look at 86 through 96. So in 86, they were like upper nines. 96, they were around 9%. Didn't really move much in that 10-year period of time. If you look like it from 1990, 9.5 to 2001, 8.2 or 2000, 8.25. Again, not a big change, right? A point and a half, fluctuation of rates over that decade or so. Um, then you started seeing things move lower for a couple years, right? But so 2000, like end of 2001, rates were in the mid sixes. Okay. By like 2010, 2000, well, let's go 2007. You're still in the sixes.
Okay.
2008, you're still in the sixes. So from like '01 to '08, you're kind of in the sixes. And there were some times where you dipped into the fives. So maybe the rate range was from like 5 to 7. And if we just go through all these 10-year periods, 2008 through 2018, you went from six, low to mid sixes. 2018, you were in the fours, but you dipped into the threes, about a 3% range. So for the most of the last 50 plus years, outside of a couple years in the late 70s, early 80s, a 6 to 10 year period of time, you saw rates within like a 1 to 3% range. Um, So let's compare what all of our clients are comparing. They're all comparing 2003. Okay, rates dropped into the sixes for the first time, and maybe in 50 years. Um, Rates were in the fives for much of like the 2003 through 2008 range, maybe in the sixes. So, and then you had time where they were in the fours and threes. So for basically 21 years, rates went from like low threes, mid threes to mid sixes, about a 3% range. I would say that if you ask someone in that 15-year period, a 3% rate would have been considered amazing, right? Amazing interest rate. A 4% rate was kind of normal. Like you were in the fours from 2010 through 2019, right? Kind of pre-COVID. Rates were in the fours most of that time, dipped into threes for a little bit here in 12 and 13, but fours was kind of average. Anything in the fives might have been considered high. So, like that 18-year period, which is what all our clients are comparing to today. Threes were great, fours were average, fives would have been considered bad. Now let's fast forward that to today. If you told someone their rate started with the five, I would think they would be pretty excited, right? I think
Mhm.
five would be considered great. Like, oh heck yeah, I'm getting in the fives. They haven't been in the fives since 2021. I think most people would consider something in the sixes average, and I think most people, if you said it started with a seven, they're like, that's crappy, that's high. And so for like the prior 18 years, threes were good, fours were average, fives were bad. I think now fives are good, sixes are average, sevens are bad. But if we look at most of this 15, 18-year run, if threes were great and fours were average, rates were in the fours most of that time. And so I think, what is the next 5 to 10 years going to look like? It's probably going to look like fives are great, sixes are average, sevens seem high. Um, hopefully we can avoid the sevens. I think the war coming to an end with ceasefires will hopefully help inflation, um, kind of keep inflation from spiking too much this year and getting into the sevens. So hopefully we don't see a surge like that, and rates can stay in the sixes. But the sixes are probably about average, and they're not only have they been average the last really 3 years, like since 2023, they're probably going to be average for the next, let's say, 3 years. And it's hard to predict beyond that. But certainly for the next 2 or 3 years, it'd be hard to expect rates going down significantly. But if they got in the fives, we'd probably all be really excited. But if we look back at this period of time, and like a lot of us were in the business, I was originating mortgages. Many of us were, many of you were selling houses. I don't remember a client in 2013 saying, I'm not going to buy because rates are 4.5, which would have been average. And that same client 2 years later, when rates were 3.4, saying, oh, rates are in the three, that's great. Now I'm going to buy. Um, People were less focused on being in or out of the market based upon interest rate movements because that's not controllable. And I don't recall a lot of people that we pre approved at some point in this 12 to 15-year period that didn't purchase for 2, 3, 4, or 5 years because they were waiting for rates to go down. Now we're in a different environment now with a little bit higher inflation, and so costs are higher, payments are higher, budgets are, I would say, more squeezed than they were for most of that decade here. Um, but to me, the messaging for customers is if you're waiting for a rate in the fives, that's like me, waiting to win the lottery. You know, I'm not sure it's going to happen. Now, the odds of the fives are probably better than me winning the lottery, but you kind of get the analogy. Um, but I think it's important when we look at this to kind of show people historical data. And we all have people that are kind of waiting on the sidelines, waiting for, let's say, rates to come down or prices to crash or something like that. And I don't see any data or market indicators that really tell me either of them are going to happen. I don't see home prices crashing. There's so much equity in homes. People are sitting on tons of equity. You're not seeing short sale and foreclosure runs. But I also don't see factors that are going to push rates to some incredibly low level. And would people come off the sidelines if rates were 5.99, not 6.6? Maybe, we've been close to it. And all I know is like what our team's pipeline is, and we have a bigger pipeline of closings in May and June than we did in February and March, which tells me that people are not buying houses because rates are 6.6 versus 6.1. The people that aren't buying houses, they weren't in the market when rates were 6.1 either. Like they weren't in the market in February. They were still on the sidelines, and they're still on the sidelines today. A quarter, 0.5% rate difference isn't going to move the needle enough from an affordability payment standpoint that I don't think that's going to pull people off the market. I think what could pull people off the sidelines into the market is them having a better understanding of the likelihood of the thing they're waiting for, which might be a rate they're never going to see, or at least not in the next couple of years. I think that's what's got people on the sidelines. Um, so all of this data, I think, is sometimes hard to explain, sometimes difficult for customers to understand. But the more we talk about it and share it and get it in front of people, I do feel like the people that are waiting for something that may not happen, if they follow you long enough, they might start to come to the conclusion that, okay, maybe it doesn't make sense to wait, for a 5.5 rate because I've been waiting for 3 years and it hasn't happened, and it's probably not going to happen the next couple years. Um, so hopefully that's helpful. I think that's the customer that isn't taking advantage of today's market, where there's certainly opportunities. That's the person. It's the one that's waiting on the sidelines and potentially waiting for something that might not happen. Um, the last thing I've got for you guys. So when we talk about this kind of topic of buyers and activity, and are people active? Are they on the fence? Are they serious buyers, or who should we invest our time with? One question that we ask them frequently, and you all are in a little bit different position than us because you're physically oftentimes showing them property when we're not, but um, you want to identify questions to determine someone's um, like buying signals. And so a question we've started asking buyers that, let's say, we pre-approved and talked to, months ago, maybe years ago, we're asking them. So let's say Aaron's a person that we pre-approved a year and a half ago. And we're checking in with him monthly and how's the home search going. It's so easy to look at houses online that people are not physically getting in their cars as much anymore. But to buy a house, most people want to physically open that front door and walk in and take a peek at it, right? Like, I don't know, we have many people buying houses without, physically seeing them. And so the question we're starting to ask all of like the old kind of aged prequels is, when is the last time you have physically looked at a property? And I think that's a question that you guys probably know the answer to, but maybe a discussion point. Because if people aren't physically looking at houses, then they're not going to make an offer and they're going to stay on the sideline. And so sometimes we just need to get them physically out into real estate, right? Open houses or show some properties. But if they're not physically seeing stuff, they're not going to buy. And so that's kind of a buying signal to us. Like if someone's like, I haven't seen anything in 3 months, well, that tells me that person is on the sidelines, probably because they're waiting for lower rates. I need to spend some time discussing and educating them on the market, but I also need to encourage them to physically see a house because it's like car shopping, like I'm sure we can all relate to this. Had no plan on buying a car, went to a car lot, drove off with a new car, right? Like lots of us have probably, experienced that before. And it's because when you physically see it, you're like, "Ooh, that's pretty cool." Like I've wanted to buy a jet ski for a couple years. Um, and I bought a jet ski a couple weeks ago, and I bought a jet ski a couple weeks ago, like right after I walked into Seminole Power Sports, because that's all it took is it went from idea to reality when I physically got there. The salesperson told me how awesome it was. My two boys were with me, like, Dad, we got to get this. This is so cool, and I bought right. But if I hadn't physically and I was researching online and looking for new and used and doing all the typical, home buyer Zillow searches, for a jet ski. when I physically stepped foot inside a showroom, I walked out the door with a jet ski on my trailer, right? And so that's a question, and you guys probably have some other ideas of questions you can ask them. But I think, we talked about this last week, and it's important, I think, and this data is hopefully helpful. We've got to identify like who's active, who's looking, and how can we educate them to show them the opportunities that are there in today's market. So hopefully that was helpful. If you guys would like any of these charts, graphs, data, any of the information we shared, message whoever you work with on our team. We will get them in y'all's hands. Appreciate you guys jumping on today on a Tuesday, and we will see you guys next Monday. Thanks, everybody.